welcome. If you are diving into investing, understanding fixed income is key. Fixed income investments, like bonds, are popular for their steady interest payments, making them ideal for generating predictable income. Knowing terms like coupon rate, yield to maturity, and credit rating will empower you to make informed decisions, especially when it comes to balancing risk and reward in your portfolio. In this video, we will break down these essential terms in simple language, showing you exactly why fixed income deserves a place in any investment strategy. Let's begin by exploring the world of fixed income and the foundational terms every investor should know. First is the coupon rate. The coupon rate is the interest rate that a bondholder receives based on the bond's face value. Think of it as the bond's interest payment. For example, if you buy a bond with a Rs 10,000 face value and a 5% coupon rate, you will receive Rs 500 in interest each year. This rate remains fixed for the life of the bond, providing a steady income stream. For beginners, understanding the coupon rate helps you compare bonds easily. The higher the rate, the more income you will earn. It is also useful to remember that the coupon rate is different from the bond's yield, as yield considers the bond's current price, not just the face value. Next is the maturity date. The maturity date is the day when the bond's principal, or face value, is repaid to the investor. Bonds have varying maturity dates. Some may mature in a few years, while others could take decades. For instance, if you purchase a 10-year bond today, you will receive your principal back after 10 years. This date is important because it indicates when you will get your initial investment back, which can be helpful for planning. Short-term bonds offer quicker returns, but often have lower interest rates, while long-term bonds pay more interest, but lock up your money longer. Knowing the maturity date helps you align investments with your financial goals. Let's talk about yield to maturity. Yield to maturity is the total return you can expect if you hold a bond until it matures. It considers both the interest payments and any gain or loss you might incur if you bought the bond at a price other than its face value. For example, if you purchase a bond at a discount, yield to maturity will reflect the bond's price increase up to maturity, making it a more accurate measure of your overall return. Calculating yield to maturity helps you see the big picture of a bond's profitability, making it essential for comparing bonds with different prices, coupon rates, and maturities. Duration measures how sensitive a bond's price is to changes in interest rates. When rates rise, bond prices generally fall. And vice versa. A higher duration means a bond is more sensitive to interest rate fluctuations. For example, a bond with a duration of 5 years would see its price drop by about 5% if interest rates rise by 1%. This term is crucial because it shows you how much risk you are taking with interest rate changes. For those new to fixed income, understanding duration helps you choose bonds that fit your risk tolerance, especially if you are concerned about interest rates rising in the future. Credit rating is an assessment of a bond issuer's ability to repay its debt, provided by agencies like Moody's, SP, and Fitch. Bonds are rated from a high of AAA to the low of D. Higher rated bonds are considered safer but offer lower returns. For example, government bonds typically have high ratings due to their low risk, while some corporate bonds might be rated lower, reflecting higher risk. A bond's credit rating helps investors assess the likelihood of default. For beginners, looking at a bond's credit rating is a quick way to gauge its risk level, making it easier to decide if the bond aligns with your investment goals.